Okay, folks, welcome and thank you for joining me. And thank you for sending all your numbers in. I mean, I was, every person in the class had their numbers pretty much, and I think there were a few numbers missing, but for the most part, everybody had their numbers in by midnight. So hopefully what you're going to see is what you sent me. I had to do a few editorial tweaks when you had when you had a currency in there. But I'll kind of focus in on what you found and use it as kind of a framework for talking about the entire class. Okay, so let's start the process. When you started the class, I said there were three ways you could put a number on a company. First is do an intrinsic valuation. You project out cash flows and discount rates and growth rates. And you essentially, and I know at the risk of being cynical, there's some theory, but mostly it's estimation based on what you already know and guesswork and forecasting, something that some of you had trouble with because it's subjective and you don't like being subjective. The second is pricing. We attach a number to an asset based on what similar assets are being priced at. And the third is if you have an asset which has a contingent cash flow, you could use real options. We talked about undeveloped reserves in an oil company, in a patent at a pharmaceutical company, essentially as options. Intrinsic valuation, pricing, and options. And one of the things right at the start we talked about is I wanted you to apply to at least two of these approaches, intrinsic and pricing, to your company, and if possible, perhaps attaching a real options value to your company. So let me kind of look at, let me start with a very quick overview of intrinsic valuation. In intrinsic valuation, you project out cash flows before debt payments, free cash flow to the firm. And those cash flows will reflect, both how much you're making as a company and how much you're reinvesting. And you put in a growth rate reflecting what you think the company, earns as a return on capital. And you discount them back at a cost of capital. You come up with the value of the operating assets. Now we covered a lot of details as we went along. So here's what I'd like to do. I'd like to do a very quick review of intrinsic valuation using a very strange template for doing so. Now, I don't know whether any of you read, if you look at Paradise Lost, Dante's famous work, it's always fascinating because this guy was, a person who believed clearly in sin and burning in hell. So the entire book is about layers of hell and what they feel like. So what I'd like to do is borrow his concept of hell and take you through some layers of valuation hell. So basically, with each mistake, you're going to be consigned to a different layer of hell. Hopefully, none of you will make mistakes and none of these layers of hell will apply. I'm going to start out with what I call the base year fixation. So as the thermometer gets hotter, the hell is getting hotter as well. So I'm going to start with the lesser sins and work up to what I think are the cardinal sins, the sins from which you cannot come back. So I'm going to start with what I call the base year fixation. Then I'm going to talk about taxes and how that can affect value. We'll talk about growth. I'm going to talk about discount rates. I'm going to talk about how you're paying for growth. So with each test, I'm going to see if you remember what we talked about as the mechanics of how to do this. So let's start with the first one. Let's say you're valuing ExxonMobil in 2009, using the financial statements from 2008. And here's what you see. You see revenues of 477 billion, after-tax operating income of 58 billion, a free cash for the firm of 54 billion. Let's say that none of those numbers is wrong, that the free cash for the firm in the most recent year was 54 billion. Let's also assume you estimated a cost of capital for ExxonMobil of 8% and a growth rate in perpetuity of 2%. So it's a mature firm, 54 billion in cash flows in the most recent year, 8% cost of capital, 2% growth rate in perpetuity. And as a throwaway, let me tell you the market cap of the firm is about 373 billion. There's 10 billion in debt outstanding. I know, doing a valuation at the spur of the moment is always difficult, but I made the numbers nice round numbers. So Matthew, can you help me out here? If I did a pure intrinsic valuation of ExxonMobil with the free cash flow of the firm, cost of capital and growth rate I've given you, can you give me a rough judgment on how much the equity or the firm is going to be worth? What's the cash flow? 54 billion, right? Cost of capital 8%, growth rate of 2%. It is a mature firm. So 54 billion divided by 0.08 minus 0.02, even if I don't count no 1 plus G.
900.
900. I'm sorry, go ahead, Matthew.
No, yeah, I was just trying to do that arithmetic. Yeah, 900, right?
900 billion, right? Stock's trading at 3. Something wrong here. Either this is the most undervalued stock on the face of the earth, or I'm missing something. So what might I be missing by using last year's cash flow? What drives the cash flows of even a mature oil company? It's oil prices, right? If oil prices are high, the cash flow is going to be high. If oil prices are low, cash flows are going to drop off. 2008 happened to be a really good year for oil prices. The cash flows were high. This is the base year problem, right? Think of how often when we do valuation, we start with the most recent year's numbers, last 12 months, and then we build off that. I know it's stating the obvious, but I'm going to state it anyway. When you take base year numbers from last year and build everything off that, there is a very real danger that you could end up misvaluing companies where the numbers go up and down. The solution is easy, right? What do we need to do? We need to normalize numbers. Easier said than done. We need to look at what ExxonMobil takes in a normal year, not what it did in 2008. And I would say many of you are facing the same challenge in 2021 when you're valuing commodity companies. 2020 was a horrifically bad year for commodity companies because of the crisis. You take 2020 and you make that your base year, everything is going to fall apart in your company. So I know it's easy once you look at it, but be careful about last 12-month numbers. You can get some very strange looking valuations if you're not careful. Now I'm going to move to a more mechanical issue. Let's assume I come to you with a company, and Shreya, you're going to help me here. I give you its income statement, EBITDA, DA, EBIT, interest expense, taxable income, taxes, net income. So I've given you the entire income statement. I've also told you that this company has zero growth going forward. Cash flows are going to be constant. Can you give me the free cash flow to the firm for this company? And I very helpfully listed out the equation for free cash flow to the firm on the right side in case you need some help. What would your free cash flow to the firm? And I've given you 6 choices. 88 million would be just the 48 million net income, adding back depreciation. The 108 million would be the EBIT minus the actual taxes paid plus depreciation. So basically, I won't read them all to you, but which of those numbers is your best estimate of the free cash flow of the firm going forward?
EBIT 1 minus tax rate, adding back depreciation.
Wait, would you add back depreciation though? Because if you have zero growth, what kind of reinvestment do you need to sustain that growth rate?
You just need to maintain it.
You just need to keep capital constant, right? If you take back depreciation, you don't put capex in, your company will actually get smaller. So basically, by making growth zero, I'm basically also telling you capex will offset depreciation, which is a nice way of saying ignore depreciation. So it'll just be EBIT times 1 minus T. And what's the tax rate here?
The effective tax rate. So it will be 30 to 180.
Is it 32% or is it 32 divided by 80, 40%? Should I be
32 divided by 80, 32
which
by
would be 40%. So 100 million in EBIT times 1 minus 0.4 is 60 million. And that's it. That's my free cash to the firm. Why am I not adding depreciation, subtracting out capex? Because my growth rate is zero. Why am I using the 40% tax rate and not the 32 million? Because if I put in the $32 million tax expense, you know what I'm doing? I'm double counting the tax benefits from interest expense. I'm saving 8 million because of interest expenses. And remember, your cash flows is supposed to be before those tax benefits. The free cash for the firm is 60 million. And keep that in mind as you work through free cash for the firm, you always have to redo the taxes. You can never take taxes paid out of a tax statement or an income statement because it will not reflect what you should be using to get to free cash for the firm. Any questions on that? The third one I wouldn't even ask you because this is something we've talked about. When you sit down to value a firm, of course, you decide how long growth will continue. And if you have a young firm like Peloton, your reaction is, it's going to last forever. And that's what every analyst who's ever tracked a high growth firm has done early in the process, to last forever. But over time, we know that gravity will work its magic. Growth rates at even the very best firms will come down towards the growth rate of the sector and the economy. And the reason is very simple. You just get bigger as a company. As you scale up, growth rates come down. And this is a graph I've shown you before, but this is just a reminder graph I keep to remind myself not to get too carried away with growth periods. It shows you how long growth typically lasts at a US growth company. You know, the answer is 3 to 5 years. 3 to 5 years, a typical IPO will see its growth rate drop to the growth rate of the sector. And if you remember, if you use my DCF, I've used a 10-year growth period. Are there companies that grow for longer than 10 years? Absolutely. Why am I not letting the company grow for longer than 10 years now? Because 10 years already puts me at the 90th percentile of growth periods. So when you see people using 25 or 50 years of high growth, you should push back. Because not only is this company valued to be the next Amazon, but what's the upside you get as an investor if you keep valuing every company as the next Amazon? So now, I'm going to ask you questions of mechanics of cost of capital. This, in fact, as I described this, I'm going to show you a cost of capital calculation I actually saw done on an equity research report, actually as an evaluation. And this analyst had made at least 5 mistakes in one cost of capital calculation. And I think you could spot all 5. Let's see, as I go through, see if you can spot all 5. So he's computing the cost of capital for a technology company. I've changed the name of the company. I'm going to call it Chippewa Technologies. It gets 20% of its revenues in Brazil. It's a US company that gets 20% of its revenues in Brazil. So I'm going to go through the computation. And as I go through, think about what I'm doing wrong. I start with the risk-free rate, but instead of using today's risk-free rate, I decide to normalize it. You know why I do it? Because rates today look too low. So I'm replacing it with an average rate over the last 20 years of 5%. Okay. For the beta, I went to Bloomberg. After all, it's right there on my desk. I look up the adjusted beta for Bloomberg of 1.20. For the equity risk premium, I look at historical risk premium. At that time, the database that was used was a database maintained by the service called Ibbotts and Associates. They had a 5% equity risk premium, a pure historical premium, but I add what's called a small cap premium, reflecting the fact that historically, small cap companies have earned higher returns than the average company, a 3% risk premium. Risk-free rate plus beta times 5% equity risk premium plus the 3% small cap premium gives me a cost of equity of 14%. So that's my cost of equity. Now to get to cost of capital, I take that cost of equity. I compute a cost of debt because a company doesn't have a rating by taking what's called a book interest rate, which is just dividing the interest expense by the book value of debt. I get a 3% book interest rate. I multiply by an effective tax rate, which is much lower than my marginal tax rate, 30%. And for the weights, I use the market value of equity, but instead of using the market value of debt, I use all liabilities because that seems more conservative. Why just stop at interest-bearing debt? I'm going to use all liabilities, which includes accounts payable, current, supplier credit, whatever else current liabilities I have. So ready, Erin? You're going to help me out. What's the first mistake I made?
I think the first one is using the normalized T-bond rate for the risk-free rate. So
try out your argument, because you're going to have this argument, I promise you, this summer with an analyst who says, why are we using a 1%, 1.7% risk-free rate? Why don't we just normalize by looking at the average? What's wrong with normalizing risk-free rates?
Normalizing removes whatever risk is actually being faced by the company today. And if we choose to normalize it, we should do it later on if we think that the risk-free rate will indeed change.
And in fact, by normalizing the risk-free rate and pushing it up, what am I doing? I'm pushing the value down, and then push the value down. I'm not going to buy the stock. And the reason I'm not buying the stock is because I think rates are too low. And if I really thought rates were too low, you know what I should be doing? Removing all my money from financial assets and not valuing any companies. It's an asset allocation decision, not whether a company is correctly valued or not. That's why when you value individual companies, it's always the right thing to do to use the current risk-free rate. And as Erin pointed out, 10 years from now in your terminal value, if you want to make that a higher number because you think that this is unsustainable, that's perfectly okay. So here, what's the second mistake I made? This is an easy one. So the risk-free rate should not have been normalized. What else should I not have done?
So I think we needed to include the country risk premium for Brazil for 20% of the revenue.
Okay, so first is, no, first, should I use a historical risk premium? What's the problem with historical risk premiums?
It needs to be forward-looking.
It's need to be forward-looking. In fact, the whole reason we do implied premiums is the implied premium reflects the future. So first is I need an implied premium. And second, as you pointed out, even though they're a US company, they get 20% of their revenues in Brazil, I need to incorporate that in my equity risk premium. So equity risk premium definitely is wrong. What do you think about this idea of adding a small cap premium? 95% of appraisers and analysts add a small cap premium. Naeem, what do you think about that idea? I can't hear you. I'm sorry. Your mic must not be working. Try now. See. I heard a beep. No, it's not working still. I'll try somebody else. I'll come back to you. Kyle, what do you think about the small cap premium? You're definitely muted. I can see you're muted.
Oh, sorry. Yeah.
Okay.
Now I'm good. Yeah. So now representative.
Yep.
Of the sector.
Well, I think first, if you believe smaller companies are riskier than larger companies, do the dirty work of estimating how much riskier, put that into your beta, right? Small cap premium is an incredibly lazy way of saying small companies are riskier, so I'm going to add 3%. And here's the second problem. That small cap premium reflects what small cap stocks have earned if you go all the way back to the 1920s. You know what's happened to the small cap premium since 1981? It's gone to zero. There is no small cap premium for the last 40 years and people continue to use it in practice. So equity risk premiums need to be updated to reflect the implied premium Brazil risk, and we need to take out the small cap premium. Sergio, what's the last mistake in the cost of equity? So the risk-free rate is wrong, the equity risk premium is wrong. I made life easy. What's the only number left that we can take issue with?
With the beta.
Yeah. And he used an adjusted beta from Bloomberg. So give me the list of arguments against using the Bloomberg adjusted beta.
Well, I mean, I would definitely go for the bottoms up beta, just reflecting
But
the
you got
different.
to give me a reason, right? Because you tried that this summer against this, a Wharton MBA and a Harvard MBA. I said, look, my book say, so give me bring out the ammunition. What's wrong with using a regression beta?
I don't think it reflects the
current mix of the company and the current debt ratios.
Exactly.
So first, that's one. What else?
It's backward looking. Yeah.
Backward looking. Finish. You're almost there. What's the third problem with the regression beta? Statistical. Remember,
That's right.
it's a statistical reason, which is
the error embedded into that.
Standard. There, you got it, right? That's it. And the reason we use bottom-up betas is not because somehow they're magically better, but because the law of large numbers works in our favor. You take 100 crappy regression betas, you average them out, it's going to be far more precise than any Bloomberg beta, however adjusted it is. So cost of equity is clearly wrong. Jesse, what about the cost of debt? What was done wrong? You used to book interest rate. You took the interest expense and divided by book debt. Unfortunately, about 60% of cost of capital calculations I see, that's how cost of debt is computed. What's wrong with taking a book interest rate?
Yeah, I mean, when you're using historicals, there could be anything going on with the interest. It doesn't really take into account what your future capital structure is going to look like.
In fact, let's take it. If I took a lot of short-term debt, what's going to happen to my book interest rate? It's going to be a lot lower because I'm moving down the term structure. If I borrowed money when rates were much lower, my book interest rate is going to be low. In fact, today, if I use a book interest rate, I might get too high a number. You know why? Because I borrowed money 3 years ago when rates were much higher. Book interest rates don't reflect what you can borrow money at today. But you know what this analyst is going to say, right? But I don't have a rating and the bonds are not traded. So what should he do, even though he doesn't have a rating?
You could look at comparable companies and, I mean, companies with similar capital structures as well. And
that's one, is maybe look at if they have a rating, you can do it. But even if you stayed within the company, you can compute their interest. I mean, you know the ratios the ratings agencies use. This isn't rocket science. You can say, given the numbers for this company, I would expect it to have a BB, a BBB. You're saying it's an estimate. Trust me, that estimate is far better than using a book interest rate. And finally, on the weights, this guy was trying to be conservative, right? He was counting all of the liabilities in. Tell me what happens mechanically to your cost of capital if I bring in everything into debt. My debt ratio goes up, my cost of capital actually goes down. That's not conservative. Debt should always be focused. It should be interest-bearing debt and lease debt, and that's it. Don't count in underfunded pension obligations, healthcare obligations, current liabilities. You might think it's being conservative, but it's actually wrong. So I decided to clean up the calculation. I first replaced the normalized risk-free rate with the actual risk-free rate, saying, I'm not God, I'm not the Fed, this is the rate I face, I can't change that. For the beta, I used to bottom-up beta. It's more forward-looking, it's more precise. For the equity risk premium, I used an implied premium for the US, and I added a country risk component for the fact that they get 20% of their revenues in Brazil. For the cost of equity, I got a much higher cost of equity simply because I'm using numbers that are better reflections of the companies, 15.68%. For the cost of debt, I came up with a synthetic rating. The synthetic rating was awful for the company. I gave them a default spread of 6%, 9% pre-tax cost of debt. I used the marginal tax rate. That's the other thing I forgot. He used the effective tax rate, but for debt, it should always be the marginal tax rate because you save interest at the margin, giving me a lower cost of debt. And I use market value weights, and I get a much higher proportion of equity and a cost of capital of 12.6%, not 8.05%. The next time you see a discounted cash flow valuation, check out the cost of capital calculation. That's the first thing you should check out. And you're already going to see how sloppy people are often in estimating cost of capital. So that's a discount rate, lots of details, but if you are careful about being sequential and work through the process, you're going to be okay. Any questions on the cost of capital calculations? Now let's talk about growth. Remember the point we started the discussion of growth by saying growth can be good for you, growth can be neutral, growth can be bad. And the determining factor actually is a very simple one, which is, are you earning a return on your capital that exceeds your cost of capital? Now, all too often, when people value companies, they get their growth rates or they get their future cash flows from management of the company. Don't ask me why they do it, but that's what they do. So let's assume you go to work for a bank or an appraisal firm, and you've been asked to value a company. And the management hands you the cash flows for the future. And you have to ask the right question. You can't be direct and say, you guys are wrong. That never goes well. So I want you to take the cash flows. So I'm the management. I've given you these forecasts of my future cash flows. And your job is to ask the right questions to make sure that these cash flows are cash flows you can use in valuation. So I'm projecting out a 10% growth for the next 4 years. I'm projecting our after-tax operating depreciation cash. So everything is on autopilot. You can see everything is growing at the 10%. So what's the first number you need to check? You need to check whether the growth rate is plausible, right? And what are some of the things you're going to check to see if that growth rate is plausible? David?
I guess you could kind of look at the sales to capital maybe, and we'll see if for each dollar of CapEx that amount of growth makes sense.
In fact, that's going to answer the question. Are you reinvesting enough to deliver the growth? So I can look at the sales to capital. I can look at the return on capital. So that'll tell me whether the reinvestment I'm projecting in the future. In this case, I'm actually reinvesting very little. If you look at how much I'm reinvesting about 20% of my after-tax operating income back into the company, which is basically we take the EBIT times 1 minus T minus free cash flow. I'm getting a 10% growth rate. Implicitly, what am I telling you about the future? Not only can I find projects, but my projects will earn a 50% return on capital. You see how I got the 50%? You take the growth rate of 10%, divide by the reinvestment rate of 20%. Implicitly, I'm assuming a 50% return on capital. You got me. Because here's all you need to ask me. What have you earned historically as a return on capital? And I'll wager my return on capital historically has been like 8%, 9%, 10%. Don't go for the kill yet. Ask, okay, so what's going to be different about the future? Why do you think your returns on capital going forward are going to be 5 times higher than the returns on capital historically? And either I will have a really good answer, or more likely, I will have no answer at all. The best way to point out to people that their cash flow projections are wrong is not by calling them wrong, but by pointing out the internal contradictions with those same cash flows. You know what my problem here is? Not that I've overestimated growth. I think the 10% growth is okay, but I've underestimated reinvestment. When you see forecasts of cash flows, dig through the numbers. And this is exactly how we looked at the Tesla valuation. Remember the Oompa Loompa valuation, where we had the growth rate being an exceptionally high number, but the company was not reinvesting back. Now let's revisit the cost of capital. One of the things analysts often do is they use what's called a target debt ratio to value a company. So I'm going to take you through the process of how they do it, and you tell me what I'm missing when I do this. So right now, let's say I'm looking at Hormel Foods. The debt ratio right now is 10%, equity is 90%. I come up with a cost of capital of 6.8%. So Jenna, you're going to be my analyst. So you believe that Hormel Foods should have a 30% debt ratio. Can you at least give me a sense of what should happen to my cost of capital if I go to a 30% debt ratio?
Oh gosh.
First, let's start with easy. The 0.1 will become 0.3 and the 0.9 will become 0.7, right? So the weights will obviously change.
Mhm.
Will anything else change? Or what about my cost of equity? Do you think I can leave it at 7.31%?
No.
And tell me why.
I don't know if I can do that.
But intuitively, would the firm be riskier to you? Let's say you're a shareholder in Hormel and they say they're going to triple the debt. Do you think the firms become riskier to you? Your equity?
Yes.
Right? In fact, mechanically, what do? We don't leave the beta unchanged as the debt ratio goes up, right? So what do we unlever the beta? You say, what a pain in the neck. But if you don't do that, I'm giving you a free lunch, right? I'm letting you change the debt ratio. So your cost of equity will go up. What about the cost of debt? Do you think the bank is going to charge you a higher interest rate if you triple the amount of loans you try to take on?
Yes.
Absolutely. The cost of debt will also go up. You're saying, how the heck am I going to figure that out? We'll have to, right? We'll have to get a synthetic rating, an interest coverage ratio, something to capture the fact that the cost. Do you see where I'm going? I see too many calculations where people just change the debt ratio. And if you do that, this is magic. I go to a 30% debt ratio, my cost of capital plummets, my value goes through the roof, and borrowing more money always looks good. So what should we do? We should do it right. We should compute the cost of capital at every debt ratio. We have to unlever and relever the betas. We have to come up with a rating and a cost of debt at every debt ratio. And guess what? The optimal debt ratio might be 30, it might be 20, it might be 10, it might be 0%. So don't just change debt ratios and cost of capital calculations. No matter what people say about target debt ratios, you've got to carry this through and estimate what the cost of capital will be. Now, Hendrik, we're now coming to the big number in our DCF, the elephant in the room, the terminal value. Let's start with an easy one for you. There are three ways in which I can get terminal value. I can use a stable growth model, growth in perpetuity. I can use a multiple of EBITDA, revenue, something to get a terminal value, or I can estimate a liquidation value. Which one of these three approaches should never be used in a terminal value calculation? Reflect at least my biases. You could do something different as a banker. Which one should never be used?
I think it's the liquidation of the assets.
Will a liquidation give you a cash flow? Liquidation is it yields a cash flow. What are you trying to do? You're trying to do an intrinsic valuation of a company, right? Remember, there are three ways you can put a number in an asset: an intrinsic valuation, a pricing, or a real option. When you use a multiple, what have you done? You've made the biggest number in your DCF into a pricing. So if you're going to do an intrinsic valuation, using a multiple is a non-starter to get the terminal value, because once you do that, you've essentially converted your value. I don't even know what it is. It's DCF in some places, it's a pricing in others. You create an incredibly unholy mess. And I'm not sure what the end value is. I know you're going to abandon this thing that I'm going to suggest to you next once you go to work, especially if you go into banking, because in banking, 80% of discounted cash flow valuations use pricing to come up with a terminal number. It should not be done, but it'll continue to be done. You can use a liquidation value, or you can use a growth rate forever. So Kushal, you be my estimate of the terminal value. Let's say that this company has 120 million after-tax earnings and cash flows. It's expected to generate those cash flows every year forever. It's all equity funded. Its cost of equity is 10%. What's my terminal value for this company?
$1,500 or 1.5 billion?
120 million is my cash flow, but of no growth. So if there's no growth,
Oh,
my
sorry, I
cost
took
of
the 2%. I took the 2% in that second point.
don't do the 2% yet. So before the 2%, it is, what's it? 120 divided by 0.1 is 1.2 billion, right? Now you gave me the answer to the 2%. So if I put in a 2% growth rate, you think it's going to become 1.5 billion? Will anything else change that? If I put in a growth rate in the numerator, what do I have? Right now, I have after-tax operating income. And the reason I use it as cash flow is because my growth rate is 0. If my growth rate goes to 2%, will I still get 120 million in cash flow?
I guess you'd have to reinvest more.
It's not even a guess. You have to reinvest more. Otherwise, you're going to have a magical growth rate. How much will you have to reinvest? It depends on your return on capital. When you change growth rates in your terminal value calculation, your cash flow has to change as well, because you cannot get growth for nothing. And if my return on capital is equal to 10%, putting in a 2% growth rate will give me a value of exactly 1.2 billion. Putting in a 4% growth rate will still give me a value of 1.2 billion. Why? Because growth, when your return on capital is equal to the cost of capital, is worth absolutely nothing. So when you think about terminal value calculations, it's going to be tempting to play with that growth rate. But if you change the growth rate, always adjust the free cash flow of the firm in your terminal year to reflect the fact that you have a much higher growth rate. You need much more reinvestment to sustain that growth rate. So let's say you come up with a firm value. Okay? You come up with a firm value of 100 million. You're trying to estimate the value of equity in this company. Sean, I'm going to go item by item, and with each item, I want you to tell me whether I should add this item, subtract this item, or just ignore the item to get to a value of equity. So I'm at 100 million value of the operating assets. I have a cash balance of 15 million. Add, subtract, or ignore.
Add.
And tell me why.
Because it's part of operating assets used to generate
or it's not part of the operating assets. And so therefore, because it's not part of operating income, I've got to add it. What about debt outstanding of 20 million? Add, subtract, or ignore?
Subtract.
Subtract, because I want a value of equity. Now comes the cross-holding nightmares you dealt with on quiz 2. Let's see if you remember those nightmares. I have a 5% holding in another company. The book value of this holding is 5 million. The market value of equity in the company is 200 million. Add, subtract, or ignore. And if add or subtract, how much?
You should add 5% of the equity value.
5% of the, which would be 5% of 200 million.
Right.
And the reason is, again, the same as cash, right? The income from that holding is not part of my operating income. And because I haven't counted it yet, I have to add it. 5% of 200 million is 10 million. I'm going to add the 10 million. Last item, since you've got all three right so far. You have a minority interest of 10 million in the balance sheet. Add, subtract, or ignore.
Ignore? I'm not sure about
when
that
does
one.
minority interest show up on a balance sheet? Does anybody remember? First, which side of the balance sheet does minority interest show up on? It shows up on the liability side. You know what it reflects? The 40% of a subsidiary that you own, that you consolidated. When I did my free cash for the firm, because I used the consolidated operating income, I valued 100% of the subsidiary. I have to subtract out the minority interest. It's very confusing. Minority holdings get added, minority interest gets subtracted out. It's not my fault. That's how I'll blame the accountant. They should have given them different names. But I'm subtracting out the 10 million because it's essentially the portion of the subsidiary that doesn't belong to me. So basically, I'm going to 100 plus 15 minus 20 minus 10 plus 10 will bring me to 95 million, I think, and you can work out the math. But basically check that out because that's the last step in valuation is those are the loose ends. And finally, if I had a lawsuit against this company where I could potentially lose 100 million, should I be reflecting that in my value? Yossi, what do you think?
Yes, you should subtract it.
And how would I do it? What did I need to do?
Subtract the 100 million from the
or the expected, because there's not a 100% chance I will lose the lawsuit. I have to bring in the likelihood that I will lose the lawsuit times 100 million, right? Every tobacco company has had this penalty attached to it for 30 years. And I wouldn't be surprised if every cannabis stock soon gets a penalty attached to it because there will be lawsuits. Finally, you come up with the value for the equity of 200 million. Okay. Neil, I'm going to start easy. If I have 10 million shares, what's my value per share?
200 divided by 10 million, so 20.
$20 per share. Would your answer change if I told you that I forgot to mention that I have 2 million options that I've given away with a strike price of $20 per share? Yeah. Would it go down, up, or it was $20 before I gave you this fact? Is your value of equity decreased after this piece of information or increased?
Increased because you got the money.
From whom? I just gave away options to a manager. Essentially, I've taken some of your equity and I've given it away, right?
So the strike price, they haven't been executed yet, the options.
And right now, if you exercise them, you'd get nothing, but they're still options, right? Even though they're at the money options, they have value in them. I've given away something of yours to the managers. The way to think about equity options is I've taken a slice of the equity that belonged to you and given it away. That's why the last step in equity valuation is subtract out the value of equity options to come up with the value of equity. Your value per share will drop the minute I give you this information, even though these options are at the money, because that's a drain on your value. And my last layer of hell, I reserve for Bruce Wasserstein and Joe Perella and what they wrote. Remember this page from way back, like session 3? What did they do? They took cash flows to equity for a target company and discounted them back at the cost of capital for the acquiring company. Remember all the thing we did about M&A, about matching up, right? They've done everything wrong. They used the wrong company, acquiring company to the target company, wrong discount rate, cost of capital instead of cost of equity. You say, what's the big deal? They used a 10.5% discount rate when they should have used a 16.5% discount rate. They overvalued the company with their own assumptions by 200 million. And the worst part was somebody actually paid the 200 million based on this valuation as a premium. And that somebody was not Wasserstein Perella. It was Kennecott stockholders. I mean, you can sue, but there's no way. Can you imagine getting in front of a Delaware court and trying to explain different discount rates and acquiring company? I mean, Delaware courts accept acquiring companies' discount rates all the time. So if you get a chance, review those 10 layers. Well, it's a very quick review of the entire class. So now let's talk about your projects. I think there were 160 people in the class, and I got the numbers back for almost all of you. The most analyzed company I was a little surprised was Shopify. I've never had a Canadian company be on the top of my list before. Lululemon and Shopify might be the two companies that keep popping up. Lululemon, is a commonly picked company. Shopify was picked by 6 people, followed by Spotify, Square, PayPal. So 2 financial service up-and-coming growth companies. Peloton. NIO made the list. NIO, of course, is a Chinese electric car company. AMD and Boeing, which are probably your drag companies. People wanted to get depressed, so they said, let me value AMD and Boeing. AMD, not so much, Boeing, definitely. And often I'm asked why I let people pick the same company. And I said, why does it matter? You could all look at the same company and come up with different values. In fact, I could have assigned the same company to everybody in the class. And there's no chance, absolutely none, unless you cheated and copied each other, that you're going to end up with the same value. Because think of how many judgment calls you had to make along the way, right? Starting with even bottom-up betas, what you call your sector, and what you built up to. But growth and margins and reinvestment. In fact, here are the 6 people who valued Shopify. First, the price per share is mildly different because obviously it did it on different days. You can see even one of the prices off maybe by a week. But look at the value per share variation. The lowest value among the 6 of you was $5.95. The highest was $1,487. There were 3 sells and 3 holds. In fact, I'm surprised there wasn't a buy in the mix. I mean, it could very well happen. And I'll come back and talk a little bit about, is there information when there's consensus? Is there information when there's disagreement? But this is clearly a company where there's a wide divergence in views about what the future will deliver. So let's start with what you found. So if you look across your companies, your median company was overvalued by about 27%. Let me repeat that again. Median company in a DCF value was overvalued by about 27%. The average was much higher, 56%. Why? Because there were a lot of outliers. Some companies valued 200, 250, 300%. The 25th percentile was minus 1.81%. So the 25th percentile, you had an undervalued company, but mildly undervalued. About 70% of the companies in the class came out as overvalued. 30% came out as undervalued. I'll show you what that statistic has looked like over time, so you can compare the number over time. But at least this semester in this class, about 70% of the companies came out as overvalued. 30% came out as undervalued. The 75th percentile was about 85%. I don't know whether you remember where your company falls or even whether it was under or overvalued. But my guess is that your company is more likely to be overvalued than undervalued given the statistics for the entire class. And here's the list of your most undervalued stocks. I bear no responsibility for any of these recommendations. These are your recommendations. So maybe if I were an investment banker, I should have all the disclaimers running below, but I'm not, because I need to take responsibility. This came out of my class. The most undervalued stock was, I don't even know what this is called, the Parker Initiative. Does anybody know it? No. Who did that?
It's a private company that I've
it's a private
for,
company.
so
Okay, let's
yeah.
take that off the list. And so there is no price. So what did you use as the price then, correct? Or whatever it was?
Yeah, I tried to find out what the actual equity value was in my DCF, and I used that as my price.
Okay, so let's take the Park Initiative. Private company. Who did that? Anybody?
I did.
And what
It's
does it
like
do?
Chinese Twitch. It's video live
Chinese.
streaming.
Okay, I'm going to ask you whether you actually bought the stock. You put a buy on it, but I'd like to know because that looks clearly undervalued by almost 61%. Its price per share is $9.11. The value per share is $30.95. And if you look across the list, there are some well-known names. Netflix comes out as undervalued. That's a surprise given how well it's done. Peloton makes the list. Netflix again, second time around. So those are your most undervalued companies. Again, I'll come back and talk about what I'm going to do with this list, but for the moment, those are the most undervalued. Here are the most overvalued stocks. The most overvalued stock was a company called Blink Charging. Again, I'm not familiar with the company, followed by Hindustan Corporates. Now, again, if you look at most overvalued, almost all of them are sell, except there's Boeing, which comes out as most overvalued, but shows up as a buy. Now, of course, the way to explain that is if your pricing gives you a buy and you go with the pricing, it's entirely possible that your discounted cash flow valuation comes up with this. But that's, again, most are sells, but there's one buy and one hold. So list of 15 most undervalued, 15 most overvalued. been teaching this class since the 1980s, and I've kept track of these most undervalued and overvalued stocks. You know why? Just as affirmation. Does this even work? Are we just playing random games? And I'll give you some good news and some bad news. On average, if you look across time, and you got to give it enough time. I can't look at spring 2020, so I give it usually about 5 or 10 years of time, and I track the undervalued and overvalued. Hey, on average, there is some information in the overvalued. So if you take spring of 1995, the undervalued stocks are the blue, the overvalued stocks are the green, the market is the red. So you can see the undervalued stocks did better than the overvalued stocks, even though they both went up. So you can see across periods, there's clearly a difference between what the undervalued stocks do versus the overvalued. I don't know whether I mentioned at the start of this class, but historically in this class, I buy one of your most undervalued stocks on your list. So if you go back to this list, I'm buying one of these stocks. You know how I'm going to decide which one I buy? I'm going to send each, I mean, obviously, let's take the Parker Initiative off the mix because it's a private company. I'm going to send each of you a very simple question, which is, are you buying? That knocks off about 3/4 of the companies because the answer I get is usually, I don't have enough money yet. I don't feel comfortable yet. In which point I'm saying, if you're not comfortable, I'm not jumping in either. But usually about 3 or 4 people in this group said, look, I'm buying. And then I look at your valuations and I decide which one of the 4 to buy. So if you add back over 35 years, that's, and 50 something semesters, that's a lot of stocks. And on average, it's worked out for me. But I'll also cover myself here. Much of the additional returns I've made from buying your undervalued list has come from letting the winners ride. So I remember in the late 90s, Apple showed up on the list as one of the most undervalued, and I bought it based on that. I already owned it, but I doubled up. And that stock over the next decade turned out to be one of the great stocks. So it's basically not that every undervalued stock makes money, but the winners are large enough. And this is a bigger lesson in investing. Often it is 1 or 2 big winners that carry portfolios afloat. And the excess returns on small and emerging market companies are greater than the excess returns on the big market cap companies, which again makes sense, right? You're bringing in some fresh information. So I am intrigued by Doyu because it's small, it's under the radar. Netflix, it's trickier because of different stories. It's a high profile company and you can say, well, maybe it's just disagreement about the future. And finally, stocks were undervalued on both a DCF and a pricing basis did much better than stocks were just undervalued on a DCF basis. The reason I say that is often we make it an either or. Do you want to do intrinsic valuation or do you want to do pricing? And my response is why? Why do you have to pick? Why can't I do both? I'm a believer in intrinsic valuation, but that doesn't mean I shouldn't look at the pricing as well. So if you can find something that's both undervalued and underpriced, I think your odds improve relative to finding something that's just undervalued. So I'll tell you which stock I end up buying. So after I prune the list, I send you that email, I will add that and I will live with the consequence. I'm not going to blame you. So don't worry. If I buy the stock you recommended, I'm not going to come back to you 2 years from now and say, how dare you ask me to buy that stock? It's down 50%. It's the nature of investing is some of these stocks, even though you did everything right, things can happen that'll affect the value and the price. Now, that's the intrinsic value. Any questions in your intrinsic valuations of companies? I think at least 10 of you came up with intrinsic values per share for your company that was 0. And you can see how that happens, right? The value of your operating assets from a DCF is less than the outstanding debt. The value of equity actually becomes negative, but you can't, since publicly traded stocks can't trade at a negative price, you're saying on an intrinsic value basis, this company is worth nothing. Does this mean you throw up your hands and give up on the company? There might still be an optionality here where you can argue I'm buying this equity in Carnival Cruise Lines, not because I expect amazing things to happen to cruise line businesses, but because there's an option. There could be an optionality here which could create value, but at least on a DCF basis, at least 10 of you found your stocks to be worth nothing. Andrew?
How do the MBA students compare to the undergraduate valuation class in terms of the percentage that we find
The
undervalued. versus
undergraduates more upbeat than you. They found about only 58% of the undergraduates found their companies to be overvalued. So you found 70. They too found more overvalued than undervalued. So that was actually an interesting difference, but you also had a bigger skew towards Chinese companies in the undergraduate class because we have a fair number of NYU Shanghai students. So I think almost 25% of the companies in the undergraduate class were actually Chinese companies. And that might affect some of this, some of the statistics you see as well. Talk about pricing. Okay? The pricing, I said, it's not that it's better or worse than intrinsic valuation, just different. In fact, I gave you a 4-step process to deconstruct pricing. I said, first, make sure the multiple used is internally consistent. Now, what I'm talking about, the numerator is an equity value, the denominator is to be an equity value as well. So divide price by earnings, so price by book value of equity, but don't divide price by EBITDA. Multiple has to be consistent. And people might think they know PE ratio or EV to EBITDA. Even Anna Kournikova seems to know what it is. But when you're sitting in a discussion of the PE ratio, EV to EBITDA, the first thing to do is make sure you're talking about the same thing. Make sure that your definition of PE and the other person's definition of PE converge, or you're talking about two different things. The second is rules of thumb are all over the place. 8 times EBITDA is cheap. Stock that trades at less. Don't fall for rules of thumb because you have the data. Play money ball. Look at the median. Look at the 25th percentile. Look at the 75th percentile. Third, don't do pricing because you're lazy, because you don't want to make assumptions. Because guess what? When you price a stock at 30 times earnings, whether you like it or not, you're assuming high growth in the future. When you price a stock at 10 times book value, you're assuming a company can earn well above return on equity. Well above cost of equity. And finally, when you go looking for that comparable group, and I don't even have to tell you this because you wrestled with this while you were pricing your stock, there are no perfect companies just like yours. You're going to have to dice and slice and make your own judgments on what a peer group looks like. And no matter what multiple you use, embedded in that multiple are assumptions about cash flows, growth, and risk. And this is a page you saw earlier when we did pricing. Every multiple has driver variables. So forget about the equation itself. The equation is not what you should be focusing on, but whatever the drivers. So for PE ratio, it's growth, payout, and cost of equity. Price to book, you add on return on equity. Every multiple has a companion variable. Knowing what that variable is critical to pricing stocks. So I pushed you to price stocks. I asked you to price it against the sector, price it against the market, and I let you pick your own multiples. And here's what you ended up picking. A lot of EV multiples. You know what that tells me? You're getting desperate because a lot of companies were losing money, price earnings ratios are not losing. You kept climbing the income statement. A lot of EV to sales and EV to EBITDA. Reflecting the companies you picked and also reflecting that 2020 was such a horrifically bad year for many companies. You had PE ratios and price to book among the equity multiples. And then you had lots of other. I don't know what the other are. I'll have to wait to see what you turn in. But clearly you can have pricing against any metric, EV to subscriber, EV to, so if that worked for your company, that's what you might have used. So the first thing I looked at was what you came up with as a pricing for your company versus the DCF valuation. You see what I was trying to get is for your own company, you came up with the DCF and a pricing. I was trying to see which one you were getting a higher number on. And I was actually surprised because the average was 114%, which means your DCF value was actually higher than the price by about 14% across all the companies. But look at the median, you get a number that actually makes more sense. For the typical company in this class, the DCF value is about 95% of the pricing. You know why that makes more sense? What do you find in your DCF? That 70% of companies were overvalued. What should you find in the pricing? Roughly half of all companies should be under. That's the essence of pricing, right? You should get more symmetry. So it doesn't surprise me that the DCF value is on average about 90, or at least on the median base, about 95% of your pricing. So you're almost underpriced. So again, remove the Parker Initiative from the list and go down. The most overpriced stock in this class was Penn National Gaming, followed by GM. And Ali, this is your pricing, right?
Show you?
Yeah.
Yeah.
So you found it significantly undervalued, but significantly, these are the most overpriced, I'm sorry, most underpriced. So
Underpriced,
it shows
yeah.
up on both the undervalued and the underpriced list. So these are your most underpriced stocks relative to the sector. Again, if you want to compare the two lists, so you can look at the undervalued list to see, like Doyu, how many stocks show up on both lists. Because as I said, historically, stocks that show up on both lists are stronger candidates for investing in because historically they've done better. And if you look at the most overpriced, again, Blink Charging shows up, NEO, a lot of young growth companies, Carvana. These are the most overpriced stocks on a pricing basis.
I do have a question.
Yeah.
I noticed when I did my market regression, though, I ended up with something a lot closer to the current share price. Is that generally the case?
It could happen. I'll tell you what probably happened. Did you use a forward number or did you use today's number when you did the market pricing?
A little bit of both, actually. I mixed some of the variables to try to give a better picture.
It might be pure chance. I think there's no general consensus on that. For most people, the market regression actually gives you a lower number than the sector regression in sectors where everything is priced up. But if you happen to be in a sector where everything is kind of conservatively priced, the market regression can give you a number that's, that's more reasonable. So I think the market regression is that, and that's why we do the market regression, is to get a sense of sobriety in the process. Where a sector gets pushed up, you want to get something more sensible, you go to the market regression. Finally, I asked those of you where it applied to do a real options valuation. But remember the conditions I impose, which is you can do this only if you have a company with two conditions. One is it's losing money. Don't try this on a money-making company. Do you remember what the other condition was, Ariana? In addition to losing money, what does a company have to do to be where you could use an option pricing model? Does to lose money and?
You need to have a high amount of debt.
A lot of debt. In other words, it's an option to liquidate. So not surprisingly, only 23 companies passed the test to be options. So if you didn't have to do an option pricing, you can heave a sigh of relief. It's because you picked a money-making company, a growth company, a company with a low debt ratio. And among those 23 companies where you did try an option pricing model, you got about a 36% increase in value relative to your DCF model. In fact, for the 10 stocks where you had no DCF value, for 6, an option pricing model gave a number for the option for the equity, reflecting that it would continue to trade more with option characteristics than a traditional equity. Now, one final point, when last session we talked about value enhancement. And I said to do value enhancement right, you got to go into the insides of discounted cash flow valuation. Think of what you would change in the company in terms of investing, financing, and dividends. But if you try to tell that to a CEO, you know what he's going to say? This looks like too much work. Give me something simpler. This looks too complicated. And consulting firms have fed off that laziness. So over the last 50 years, consulting firms keep inventing what they call shortcuts to increasing value. They say, this DCF stuff, so much work, we'll give you something else you can focus on. 40 years ago, an outfit called Holt Associates came up with a concept called CFROI, fancy word for, we're just going to take your cash flows and compute an internal rate of return. Higher CFROI is better than lower CFROI. About 30 years ago, an outfit called Stern Stewart came up with a measure called EVA, or economic value added. Sounds fancy, but it's a difference between return on capital and cost of capital. And here's what they told companies: earn more than your cost of capital. And companies said, that's amazing, tell me more. And they said, you make even more, you'll be worth more. And and they sold this to half of the S&P 500 companies, 250 companies. They got paid tens of millions of dollars of consulting fees for stating the obvious. But the sales pitch they often make is, hey, pick this variable. And if you pick this variable, it's going to give you a shortcut to create value. But every shortcut comes with a cost. So I'm going to very quickly focus on these two measures, EVA and CFROI, because they were among the most highly touted measures at consulting firms and banks. EVA, you take the difference between return on capital and cost of capital. Is that new? Of course not. We've known this in corporate finance for a long time. You need to earn more than your cost of capital. If there was an innovation in what they did, they took that spread, which is a percentage spread, and multiplied by the dollar value of capital invested. So you know what they were trying to say? If you make an 8% spread, it's better to make that spread on $1 billion rather than 100 million. Again, completely intuitive, which is if you can make that spread on a larger amount of money, it should be worth more. And they told companies to go out and increase their EVA, which is an annual number. CFROI is more like an internal rate of return. So if you think of EVA as closer to NPV, CFROI is closer to the IRR for a project. You want to earn more than your cost of capital. Both measures are very intuitive measures. In fact, one of the things that used to drive me crazy is in the 1990s, Stern Stewart, it was founded by two guys, Joel Stern and Bennett Stewart, and Bennett Stewart could sell refrigerators to Eskimos. The guy was the greatest salesperson on the face of the earth. And he'd show up at CEO at CFO meetings with a prop, and his prop was always the Coca-Cola annual report. In the 1990s, Coca-Cola was your star company, a company that was growing, earning well above the cost of capital, creating value, market cap was up. So he'd show up in front of these CEOs of these companies with stagnant stock prices. He'd hold up the annual report and say, do you want to be like Coca-Cola? And all the CEOs says, yes, we'd like to be like Coca-Cola. He says, Coca-Cola has adopted EVA. Remember all those high school classes, A leads to B, B leads to C, so A must lead to C. And they say, oh, really? So if you adopt EVA, you can be like Coca-Cola. And like magic, half the people in that room would pay tens of thousands of dollars to Stern Stewart to come in and compute the EVA for them. So after being blindsided in a couple of panels by Bennett Stewart holding up the Coca-Cola annual report, I decided to come up with my own props. So actually, I think it was in New York, it was at one of these CFO seminars. So Stern Stewart gets up at Coca-Cola, he holds up the annual report, and he says, do you want to be like Coca-Cola? Everybody applauds, we're going to adopt EVA. So when my turn came to speak, I brought my own props, which were these Nike Airs, the tennis shoes. I said, do you want to be like Michael Jordan? Remember 1990s, who didn't want to be like Michael Jordan? Michael Jordan wears Nikes. And then I sat down and I put the Nikes on. People would say, what the hell is this guy doing? And I said, somebody point me towards a basketball hoop. I'd like to slam dunk a basketball. You know what chance I have of actually slam dunking a ball? The only basketball hoop on which I can slam dunk a ball is one of those Fisher-Price ones that you get for your little kid, which is like 3 feet off the ground. I can wear all the Nikes in the world, and I'm not going to get anywhere within 3 feet of that hoop, even if I had a trampoline to jump off. But my point was a simple one, which is just because I wear Nikes doesn't make me Michael Jordan. And just because you adopt EVA doesn't make you Coca-Cola. Coca-Cola was successful despite EVA. You know why? Because they had an incredibly strong brand name that far preceded anything they did with EVA. But consulting firms take ownership of success. It's because of us that this has happened. So you will hear people talk about magic bullets, some new metric that people have come up with. And I can almost promise you that no matter how much weight is put behind the new metric, it's just old wine in a new bottle. The basics of value don't change, no matter what metric you've created. So finally, after you came up with your value and price, I asked you to make a recommendation. You know why I make you do this? Because otherwise it's an abstract exercise. And I gave you 3 choices: buy, sell, or hold. I can't go into your mind of how you made these choices, but let me go through some of the things that you probably felt when you got to this point in your project. You got a DCF value, you got a pricing, you got a price per share. A lot of you are saying, but I don't feel sure yet. It's natural, right? See, if only I have more information, I do more research, then I can make a decision. Trust me, there is no amount of research that you can do which will make this feeling go away. You will never quite feel sure. You got to be okay with feeling uncertain. The second is, you can say, look, markets are efficient. This is all an exercise in number crunching. You can go back and feed numbers into your DCF and make your DCF equal to the price. Or the third is that you look at evaluation. So look, I don't have to be right. I just have to be right on average. So if Ali buys you, and she says, look, I'm going to put all my money in the stock, I would try to talk her out of it, because that is hubris, right? To say, even if you've done your homework and you believe a stock is undervalued, put all your money in that stock, you're asking for trouble. But if you can find 5 or 10 undervalued stocks and you can spread your bets, you don't have to be right on every one. You just have to be right on average. You say, but you're saying, but you're buying only one stock from this undervalued. You know why I can afford to do that? Because I've been teaching this class for 58 semesters. There are 57 other stocks that have already found their way into my portfolio. I've shed about half of them after they've paid off or not paid off. But when you have a portfolio already, it gets much easier to say, look, I'm okay with being wrong. And you have to get to that point to actually be able to pull the trigger. Because as long as your entire wealth is riding on being right, you can never feel comfortable enough to make that final judgment. So you want to see what you recommended? There were 42 buys in this class. There were 88 sells. And there were 28 holds. More chickens than usual in this class. People saying, I don't feel sure, I don't. But the buy to sell ratio, if you look at it, is actually the lowest number I've seen since spring of 2014. So see this brown line? That's buys versus sells. So when that number is roughly 1, the number of buys and the number of sells are roughly the same. There have been periods where the buys vastly outnumber the sells. So for instance, spring of right after the dot-com boom bust, you can see the number of buys vastly exceed the sells. There again, 2009, after the 2008 crisis, number of buys exceeds the sells. Where, I mean, I'm not sure what to read out of this other than the fact that this is the most downbeat class I've had in a decade. And there's good reason, right? It's not that you don't think your companies are worth a lot. It's the price has become, stocks are being priced so richly, it's becoming much more difficult to find undervalued stocks. So you can look across time and I will put your, I will take your names out of the report, but I'll create an Excel spreadsheet with all of your valuations. And I'll put them online. You can download it and then do with it whatever you might. But to the extent that you have the information, you can make your own judgments. So let's see where we are. At this point, you should at least feel comfortable with what we're trying to do in intrinsic valuation. There still might be details in DCF you don't quite get, but you get the process. You're trying to estimate. We also have to have a sense of how to price something, but which valuation approach you use ultimately will depend on both you and what your job requires and what kind of assets you're pricing. If you're looking at real estate or you're looking at baseball cards, all you can do is pricing. It's very difficult to do intrinsic valuation. So it's going to depend on the asset that you're looking at, and it'll depend upon you. Remember we talked about time horizon and how it plays out here? The longer your time horizon, the better target candidate you are for intrinsic valuation. So think about your time horizon. Think about the reasons you have for doing the valuation. Is somebody paying you because that's going to drive bias? And what do you think about markets? Embedded in every action is a judgment call you're making about markets making mistakes and how they correct their mistakes over time. And I'm going to put the question up, and there's no right answer to the question. This is a question I asked you, I think, in the second session of this class. And I said, I'll come back with the same question once you've got your hands dirty. Now that you've done a DCF and you've done a pricing, and you had a chance to think about how much uncertainty you felt in each, make your choice. And it could be that you're a believer in intrinsic valuation, that you're a believer in pricing, or you might have concluded after this class that the market's not that stupid after all. The market perhaps has capacities to put numbers on things you never could feel comfortable doing. And that's a perfectly healthy response to a valuation class, at the end of the class, to say, look, I'll do valuation if you hire me to do valuation, but when I invest, I'm just going to put my money in index funds and move on, because I don't feel comfortable picking individual companies and putting my money on them. And that reminder, the session we did on storytelling and number crunching, my strong advice is that you work on your weak side, which is if you're a natural storyteller, even though numbers make you uncomfortable, get working with more numbers. If you're a natural number cruncher, cut yourself some slack. Let your imagination run riot for a while. Make estimates that you know are going to be wrong, even though they make you uncomfortable. because you need both sides of your brain working for this process to play out. So I'm going to leave you with some final pieces. I don't even want to call them advice because it sounds too profound. First, no matter how much we circle around, whether you're doing valuation or pricing, it's always about the fundamentals, right? No matter what people say about cash flows, growth, and risk, they don't matter. Ultimately, they're the only thing that matter when you buy shares in a company, when you buy bonds, the cash. Second, it's so easy to get distracted in this process. There's so many distractions along the way. Focus on the big picture. That's why I want you to look at that. When you do a DCF, pull all the numbers together in one page so you can see what's going on. Because if you let this run to 10 pages and 500 line items, you have zero chance of doing it. And don't sweat the small stuff. There's lots of small stuff. Like what? Like spending days trying to estimate working capital requirements for a company. Working capital is 1% of revenues. Spending 70% of your time in evaluation coming up with discount rates when you know that the range of discount rates for a publicly traded company at the start of 2021 went from 5% to 7% for 80% of companies. You get out there, there are going to be a lot of people who tell you war stories about the stock they bought in 98 and sold in 2005 and made a ton of money. This is a business where experience adds very little to how good or bad you are. In fact, I've seen people who've been investing 40 years, done valuation 40 years, who are terrible at doing valuation, and people who started last year really good. So don't let anybody tell you, look, I've been doing this for 40 years. Therefore, I know what I'm doing. The two don't connect. And final two pieces of advice. Keep, there's nothing in valuation worth losing sleep over. Keep your perspective. It's only evaluation. Nobody's going to die or live based on evaluation. I still remember it was the end of a valuation class, I think from like 15 years ago. Second year MBA who's graduating comes up to me at the end of the class and she said, she's a history major from Yale who came back for an MBA. She came up at the end of the class and she said, I never thought this would happen, but I have a job as a sell-side equity research analyst. She turned out to be really good at valuation. And I said, my condolences. No, I said, my congratulations. And she said, I'm really scared. I said, what are you so scared about? She said, what if I make a mistake? I said, be glad you're not a brain surgeon. Brain surgeon makes a mistake, somebody dies on the table, you make a mistake, what's the worst that's going to happen? Somebody gets a little richer, somebody else gets a little poorer. Just make sure that somebody else who's getting a little poorer is not you. Think like a Marxist. Move some wealth around, nothing terrible has happened, move on. Let things go. I mean, this is a valuation. You have to be willing to let your mistakes go because you will make a lot of mistakes. Why? Not because you're not doing things right, but because you're not God. It's a reminder you should have every day. I'm going to screw up. It's okay. But I'm going to try my best on my next valuation. Final point, if you're ever given a choice between knowing everything there is to know about valuation and being lucky, you know which one you should pick? Pick being lucky. I hate to be the one conveying this message, but this is a business where luck is the dominant paradigm. If you're in the right place at the right time, I don't care how uninformed you are and how bad your decision-making process is, you'll make money. If you're in the wrong place at the wrong time, I don't care how much homework you've done, nothing's going to work out for you. Be lucky. Brought home a message brought home to me by my mother-in-law when she came to visit about 20 years ago. So she comes, it's the peak of the dot-com boom. She shows up and she would drive us crazy. She'd turn on the TV and watch the market all day long. I don't even remember, it was pre-CNBC. I didn't even know what she was watching. And every time one of her stocks went in the ticker at the bottom of the screen, she said, go Cisco, go, convinced that this was actually pushing up the stock. And all day long, all she would talk about what was in her portfolio, what was out of her portfolio, what she wished was in, what she would. And I had to act like I was listening. That's what son-in-laws do. And then she let it slip that she owned Cisco. And I said, Judy, why did you pick Cisco? She said, because I like the vegetable oil. I said, that's not Cisco, that's Crisco. And after she left, I did try her strategy. I'd pick a stock in the news, pick something that rhymes with it and see if it worked, but it didn't work for me. Don't underestimate the role that luck plays. People make lots of money for all the wrong reasons. People lose lots of money for all the right reasons. There's no justice in the world. So be superstitious. If you find that you get your venti cappuccino, the same Starbucks every day, and your stocks seem to go up when you do that, keep going to that Starbucks. Even if you have to drive 3,000 miles to get there, just go there. It's not worth messing up. So if you want to do, how in India, everything has to be at an auspicious time. Now, when I was younger, I used to think, that's so superstitious. You know what? Give me the auspicious time, pray to all the gods in the world. It kind of hurt. And in this process, it can only help. Be lucky. And I know most of you are graduating and soon will start working, August, September, whenever you start working. I wish you the very best. And if you ever have a valuation issue that you want some resolution on, you want to call me in as I would say impartial broker discussion. Don't assume I will always take your side, because if you're wrong, I'm going to say, hey, the other guy is right or the other person is right. If you ever have a question you're running into in class, and if there's somebody who wants to use a Bloomberg adjusted beta, just put me on, whatever that discussion is. And I'll try to talk that person out of that process. But I wish you the very best. And I will, obviously, I'll send you a couple more emails before the final exam. The final exam is day after tomorrow. And I think I told you the time. It's going to be available from 4 a.m. New York time to, I think, 8 p.m. New York time. So 16 hours. It's a 2-hour exam. So good luck, and see you later. Take care.
Thanks, Professor.
Thank you, Professor.
Thanks, Professor.
Thank you very
Stay on
much.
for a couple of minutes if you have any questions
you.
about the final or the
Thank you.
Professor.
Welcome. Bye-bye.
Professor, I have a quick question.
Yeah.
I think I've asked you this before, so I apologize. But when you
okay.
went through the Disney example, I noticed I didn't have an answer to my question. So you used the reinvestment rate and the return on capital to come up with the growth rate in after-tax EBIT for Disney. Yeah. But I think when I asked you this last time, you mentioned not doing that as a sort of a consistency check.
If you leave your margin, if you take the existing model and leave the margins constant and the sales to capital ratio equal to what it was last year, you're actually going to see a growth rate as return on capital times reinvestment rate. So if you take a company's existing margin and existing sales to capital ratio and you leave them constant over time, your growth rate will then work out to be return on capital times rate. It's a special case. But if your margins change at all over time, then the equation is going to break down. That's why the sales to capital times, and margins are always going to work, because that's designed to be a more flexible model. But if you have a company with stable margins, then in a sense, you're saying, why do I care about revenues? Because my margin is always 12% of revenues. I'm going to tie my reinvestment directly to my after-tax operating income. That's what you're doing when you do return on capital times reinvestment rate. So when your margins are stable, then you can get away using return on capital times reinvestment rate, which is in a sense more intuitive because it makes you think about cost of capital. When you go to sales to invested capital, what you lose is you don't have the natural anchor of, is that a reasonable number or an unreasonable number, right? Because with the return on capital, we use a 50% return on capital. So that's a high number. But if you use a sales to capital ratio of 4, you're saying, I have no idea what's reasonable, because you have no metric to compare to. So you do lose something by going to the more flexible model. And that's why I always compute the imputed return on capital when you use a sales to capital ratio to remind you, hey, this is the return on capital you're implicitly assuming. Are you okay with that?
Got it. So in that Disney example, we were assuming the same margins in the forecast period. Got it. Okay.
Yeah.
Thank you. Thanks again for all the time this semester.
Take care.